Here's the dilemma. There is in the country a great deal of anger about the financial institutions, including those represented here. There has to be on the sense of the American people that you understand their anger, their frustration, and that you willingly cooperate and, in fact, are willing to make some sacrifices so that we can get this whole thing working.
The measure of strength for a country and a company is not whether or not they have problems, it's how they deal with those problems, overcome them, identify them, and move on. I am confident that we will do this again and that we will all emerge better because of it.
We will all emerge better because of it. All is the important word there. What a difference a decade makes. That was then Congressman Barney Frank going toe-to-toe with J.P. Morgan's CEO and chairman Jamie Dimon on Capitol Hill in an explosive hearing more than 10 years ago. Remember this. At the time, the country was still reeling from the financial crisis, and Congress hauled in 8 of Wall Street's biggest bank CEOs to explain how they spent billions in taxpayer bailout money. Now, today, heads of 7 banks, including Mr. Dimon, are being called back before the House Financial Services Committee. And while the market is doing extraordinarily well, the country is enduring a financial crisis of a different kind. The growing economic disparity between the folks at the very top and everyone else. I want to bring in my panel, Bill Cohan, the author of Why Wall Street Matters, a book that defends Wall Street and the big banks. He also worked for J.P. Morgan Chase and Lazard. My friend Scott Galloway, professor with the NYU Stern School of Business and founder of the business intelligence firm L2. Bret Stephens and Megan Murphy back with me. Bill, I want to start with you because here's the issue I see. Maxine Waters, no doubt, is going to go after these CEOs today. But if we take the last 10 years, what did they do? They took an enormous amount of bailout money. They made huge mistakes. I'll concede all the people they took advantage of during the subprime crisis. The problem is they didn't actually break a law. So they didn't go to jail because they didn't break a law. And now the TARP money, they paid it all back. Those banks are better capitalized, shareholders have done really well, and their lending practices are tighter. So Jamie Dimon's going to walk in today and say, listen, regulations are good, everything we did was positive, and everything is going well. But the problem is, for half the country, it's not. For all of those people who suffered during the financial crisis, their credit scores are destroyed. Almost half of black people in the United States, 44%, their credit scores are below 620. They're locked out of the banking system. If you think about the 40% of Americans who don't have $400 for an emergency, they're screwed. But is it these bank CEOs' responsibility to fix it? Because that's what we're going to hear today.
Well, Stephanie, there's a lot to unpack in what you just said, and I think there's an important question in there. First of all, I have to tell the viewers that I also wrote 3 books that were highly critical of Wall Street.
You did.
One book that was trying to defend what some of the basic things that Wall Street does that we often forget. What has changed in 10 years? I mean, you're right. They took TARP money. They paid it back with interest and warrants. Remember, the government got warrants.
Government made money.
Made money on all of that. The banking system is obviously much safer than it was 10 years ago, but there are still fundamental flaws in our banking system that no one has ever addressed. Nobody wants to address because they're too fundamental to the way banks work. One is, of course, the way they finance themselves on a daily basis, how they fund themselves. Banks are in the business. We have a fractional banking system of borrowing short and lending long, and there's nothing that anybody's going to do about that, save for, forgetting the fractional banking system, which isn't going to happen. So, in other words, there's always going to be some risk in the banking system if everybody freaks out at the same time and wants their money back and it's not there. Secondly, and more importantly in my view, because it's actually can affect people's behavior, is of course the compensation system on Wall Street, and you're looking at me like you knew I was going to say it, is because that has not changed in 10 years, and that still rewards people on Wall Street for taking big risks with other people's money. That has not changed, and until that changed, you're not going to change people's behavior because people are very simple. They do what they're rewarded to do, and they're still rewarded on Wall Street to take big risks with other people's money. And so we're asking for, I could go into why the debt markets are very risky now. I've written a lot about that for the New York Times and other places. I mean, there are lots of risks in this market in addition to the unfairness that you talked about in income inequality and people not having $400 in their savings account to get the money they need in an emergency.
Scott, Jamie Dimon can talk all day long about their philanthropy and the money they're spending on workforce development, and that matters. Yep. But at the same time, they're making $2 billion last year in overdraft fees. And who do you think that hurts? The small business owners that have a accounts with JP Morgan.
Yep.
But technically, legally, he's allowed to do that. So how does Congress go after these CEOs when they're actually adhering to the law? Change the law if you don't like what they're doing.
Yeah, I don't think you can. I don't think any of them can disarm unilaterally. And to Bill's point, the gestalt around risk is unhealthy because as someone who's run venture-backed company and is taking risks with other people's capital, I think that's a healthy part of the economy. But the difference is if I go out of business because I take extraordinary risk, I don't get bailed out, I don't come back. So it changes the level of risk I'm willing to take. So at the end of the day, if you know you get bailed, if Jamie Dimon called Jerome Powell at home tonight and said, boss, I got some weird news. We've had this anomaly, 100-year flood thing happen, rogue trader, throw out all the big words. I don't know what to do, shrug my shoulders. They get bailed out because the curse of bigness, and professor at Columbia of Law, Tim Wu, wrote a great book on this. The banking industry is not robust. McDonald's takes stupid risks, goes out of business. We're all going to Chipotle. We're still eating. We're still fine. JP Morgan goes out of business. It could tank the global economy. So this promiscuous risk-taking that is rewarded and the curse of bigness, we need regulations. We need to let people fail, and we need to break these guys up.
And meanwhile, we're in a deregulation phase. And regulation for these 7 CEOs has been fine. They've got regulatory capture. If you hit Jamie Dimon with more regulation, with more compliance requirements, he can easily ship in another 1,000 compliance officers and not even sweat it. But small and mid-sized banks are the ones that got choked out. So these guys can say, yep, we're more responsible, we're cleaner, we're better, because they followed the rules. But did the government put together a bunch of crappy rules?
Well, Stephanie, as you know, I was a banking correspondent during the crisis, and oh, the irony, last night I actually had the pain of reading the 7 white male banking CEOs that will be testifying today and reading their statements.
They can't change the fact that they're 7. Jamie Dimon couldn't become an African-American woman this morning. Like, they are 7 white guys who are put into those jobs,
Even Jamie Dimon cannot do that. I know they're hoping he'll talk for them. But look, how little has changed. But oh, the irony of reading last night all 7 CEOs saying how thankful they were for Dodd-Frank, how thankful they were for the opportunity to be regulated by the government, how thankful they were for things about the Volcker rule, which tried to prevent them from taking excessive risk with other people's money. But what Scott says is the most important point. The banking system has a systemic flaw, which is this. They remain too big to fail. Yeah. 10 years after the crisis, you are exactly right. If one of the big banks reported an extraordinary risk, and guess what? This hearing today will be a lot about the last crisis. What I focus on is what is the next crisis, and that is always what is unpredictable, whether it will be algorithmic, whether it be computer trading, whether it will be something in auto lending, in real estate, which is where we see most crises. Will this hearing be focused on what is the next systemic risk, and will we not put the American people in the position of bailing out banks that not only were supported by the government, propped up by the government, bailed out by the government, but yet again, over the last 10 years, have made a fortune from artificially low interest rates and quantitative easing. And you want to know what contributes to income inequality? It is that 1 out of every 4 Americans underbanked. Nearly 50% of this population were laying on excessive rates, payday lenders living paycheck to paycheck from a system that still does not support them. Ask them those questions,
so
not what
when
happened 10 years ago.
Tightened up their lending standards to improve their balance sheets, more people got knocked out of the system and are forced to go to payday lenders. Bret Stephens, when you look at this whole picture and you see the broken economy, the fact that Jamie Dimon is now using Elizabeth Warren talking points, talking about all the Americans that don't have $400 in terms of if there's an unexpected emergency, shows how broken the system is.
It also shows that Dodd-Frank was a very problematic bill that entrenched a kind of oligopoly of banks that have profited handsomely because, as you pointed out, it's nothing for Jamie Dimon to hire another 20,000 compliance officers or whatever it is.
But if you're a community bank in Ohio, you're going to go out of business.
You're finished, and that's exactly the problem. That you now have a system of about 7 or 8 large banks. They have no competition to speak of. No one thinks of, hey, I'm going to start a bank. People look elsewhere. And so the next time we have a big reform, people have to be mindful of the fact that as you improve those lending standards, you don't want to create a market where you can only have 3 or 4 major players.
But isn't short-termism the real issue here? Financial engineering. Let's say Bill Cohan is the CEO of a major company, and I'm a big investor in that company, right? And I'm a big investor in that company. And a bomb hits this building.
Right.
I can just sell my stock that day. Maybe it goes down by 20%, but I'm out of the position.
Yeah.
He runs that company with 50,000 employees, and he still has to deal with it.
Yeah.
For the financial industry, the fact that it is so loosely regulated, the fact that activist investors can come in, shake up a company, and when they shake it up and optimize it, we know that means people lose their jobs, and they're not held to any standards. Is that not one of the main issues here?
Yeah, but we keep hoping that the better angels of a CEO are going to show up. And at the end of the day, people will. I've served on a bunch of public company boards and on the comp committee. People will largely, their behavior will be driven by their compensation. And when 98% of senior executive compensation is based on the option value of their equity, they're going to focus on the stock price morning, noon, and night.
Because that's what their job is. And unless we change the rules of capitalism.
That's right. And they're doing their job. The people who aren't doing their job, quite frankly, is us. We need to elect officials that recognize the incentives are out of whack, and we need referees on the field that realize these guys are too big, that realize if you, in fact, make $100 million in equity value by putting in place risk that someone else down the road has to pay back, that we can claw it back. I say hate the game, not the players.
I agree with you 100%. Bill, one of the problems is if you run a publicly traded company, if you want your stock to go up, you have to grow. So you're seeing acquisition after acquisition after acquisition. And what does that mean? Optimization, and people are losing their jobs. Do we not have to revisit not just regulation, but simply the rules of capitalism? Because today, when Maxine Waters goes after these CEOs, you and I both know trading floors across the board are going to say, uh-oh, we didn't vote for Trump last time, but maybe we should this time, because our option is going to be capitalism or socialism. Why does it have to be one or the other? Why can't we say, let's revisit capitalism and improve it?
Well, and of course, the irony, you're absolutely right, of course, and that was the point of why Wall Street matters. Let's fix capitalism where it's not working on the margins. Let's fix Wall Street where it's not working on the margins.
You mean like carried interest, where both parties during the election said, let's get rid of carried interest.
Quantitative easing.
And then there was a huge tax cut, and no one got rid of carried interest.
What other industry on the face of the earth gets its raw materials for free? Banking gets its raw material money for free because the Fed has kept the rates low for 10 years, and now President Trump is jawboning the Fed and trying to stack the Fed with people who are going to try to keep rates even lower. That works great for the Jamie Dimons of the world and the banks of the world, but it doesn't work great for people who are going to suffer with all this mispricing of risk that goes on in the market, as you well know.
Speak to the perversion of that. Quantitative easing, QE, came after the financial crisis when we needed central bankers to come in and say, let's lower things so people can lend, so people can borrow, so it won't cost that much. Now, President Trump says the economy is stronger than ever, and by the way, let's cut rates. He might actually be successful in bullying the Fed to not raise rates, and Wall Street's going to go, that was the wrong thing to do. Ha ha, but we'll take it, and the little guy will get screwed again.
Laughing all the way to the bank, and we should point out Jamie Dimon taking home $31 million in 2018 for his compensation, the highest he's had, record profits on JP Morgan. And let's be really clear about this. Let's not make this false dichotomy between capitalism and socialism. Let us not posit that to the viewers or to anyone out there. Those are not our choices. Our choices are having a more responsible banking system that serves the benefit not of the 1%, not of the 0.1%, which it does to such an extent now with so much financial machinery that goes on, but a banking system and, frankly, a regulatory system that serves the vast majority of the American population. That means an increased, a bulked-up Consumer Financial Protection Bureau that goes out and tackles the banks that are predatory lending, that tackles the banks that segregate low-income communities and do not give them the access to capital they need to get in the banking system. Do you know what a perversion the perversion truly is? People who are underbanked, who are paying excessive fees, excessive rates to do normal everyday things, to get a car, to take their kids to school, to take care of their parents. That is the perversion.
I don't have to pay wire transfer fees. I have banks make no money. Don't put the choice between capitalism and socialism. Let's put the choice between better capitalism, more efficient capitalism, fairer capitalism, and that is what benefits the American public, and that is our future.
That help savers at the expense of speculators, which is the opposite of what we've had for the last 20 years.
Absolutely.
Last point, Scott?
Love this. The question I have, yeah, it all makes sense. But to your point, we can't mistake cronyism and kleptocracy for capitalism. Capitalism involves democracy and referees on the field. And unfortunately, when you pervert capitalism the way it's been perverted the last few years, we have an outsized reaction to the right in the form of nationalism and even fascism, and what I would call sort of this PG-13 socialism, which I think is also a bad idea. Capitalism works, but we just need referees on the field.
And then one final point. And then you have the irony of the billionaires like Jamie Dimon and Ray Dalio trying to lead the charge in the public sphere about how we need to reform capitalism and they should be charged higher taxes, et cetera, making themselves look like the good guys when they're frankly part of the problem.
Well, they could say, you know what, we're not going to charge any overdraft fees anymore. Jamie Dimon could say, you know what, when you deposit your money in my bank, maybe I'm going to give you a little more.
Exactly.
Maybe I'm going to charge you a little less for your credit card.
Hey there, I'm Chris Hayes from MSNBC. Thanks for watching MSNBC on YouTube. If you want to keep up to date with the videos we're putting out, you can click subscribe just below me or click over on this list to see lots of other great videos.